Hey, everybody, we are officially back in a bull market. Now, it's kind of complicated because technically a bull market starts when the market bottoms out and then reaches a new all time high, but you don't know when that happens until the market actually reaches a new all time high. Now it has, so we are officially in a bull market once again, and it turns out we have been in since for some time now. Um, but there are still some good stocks to be found in the market. Tyler and I have been doing some buying and are continuing to do some buying as we head into February. Before we get into the stocks we're buying, take a minute, click subscribe to my channel, and check out the link you see on your screen for a message from my sponsor, The Motley Fool. You get the top 10 stocks to buy right now, and it's the best way to support this work we're doing on YouTube. So I'll start because Tyler always has the most interesting stocks, so I'll save that one for last. Mine is a familiar favorite. It's already one of my larger positions. One that I am adding to that I think could be a big winner in 2024 is Bank of America. Ticker symbol is BAC. They are my longest running bank stock investment, and I think they are still best in breed when it comes to the big four banks, especially when it comes to relative to their valuation. JP Morgan Chase, you could definitely make the case, is the best bank out of the big four, but it also trades for a premium valuation, and Bank of America does not. So right now, Bank of America actually trades for just under its book value, which is kind of rare in considering how well the business is doing. So there are mixed results. There's good and bad in the business. In the fourth quarter, they reported that for the full year, they had 4% annual revenue growth, which is decent given that the economy was quite uncertain throughout 2023 and with all the banking drama that happened toward the middle of 2023. Earnings were down 3% year over year. Total assets continue to grow. Their loans and deposit base are roughly flat, which I got to say, for Bank of America to not lose deposits at a time when they're paying like 0.1% on savings accounts and you could easily find 4 to 5% elsewhere, that's pretty strong customer retention given the environment. They're considered a very safe bank. When all the regional banking stuff happened, they had been losing some deposits, but those came flooding back in because of the safety. They are a too big to fail bank, and people are willing to put up with low yields on a lot of their money in exchange for the perceived safety. But speaking of yield, that's been their big Achilles heel. Their net interest yield has steadily gone down from about 2.85% in the first quarter to 2.47% in the fourth quarter. It may seem odd that with interest rates rising throughout 2023, their net interest yield is going down. But think of it this way. Sure, they're making more money on the new loans that they're issuing, but the new loans they're issuing are a very small portion of their overall loan portfolio. Bank of America's biggest type of loan on its commercial balance sheet anyway is residential mortgages, which are 15 or 30-year loans. So a lot of them, most of them actually, were issued with low interest rates before mortgage rates started to rise. Pretty much everyone I know refinanced in the 2020 to 2021 timeframe. So a lot of low yielding mortgages are sitting on Bank of America's balance sheet. Meanwhile, their deposit cost has risen significantly. They're not actually paying 0.1%, like I mentioned, but it's not competitive with high yield online banks. So anyway, point is that the rates they're paying on deposits is outpacing the growth in their yielding loan portfolio. That's been a negative catalyst. But the business itself is growing. Bank of America added 600,000 net new checking accounts in 2023. They've grown the number of checking account customers in 20 consecutive quarters, which is a very impressive statistic. They added 4.6 million new credit card accounts. Merrill Edge, their investment platform, they acquired Merrill Lynch during the financial crisis, over a decade ago. That saw $49 billion of net inflows. Their net charge-off ratio is up, but it's kind of reverting back to pre-pandemic levels rather than anything to be concerned about. A 0.45% net charge-off ratio is really not a big cause of concern for me and shouldn't be for many other bank investors. And most of the net charge-offs are credit cards on the consumer banking side and commercial mortgage loans on the commercial side, or commercial real estate loans on the commercial side. I mentioned it's a cheap valuation play. It should be a big beneficiary of lower interest rates as that deposit cost comes down. You should see their net interest yield rise. just under book value. They trade for about 11 times forward earnings estimates. And it's just looks like a great time to add. I think Bank of America could be a a $40 or $50 stock if interest rates cooperate this year. And it's one of my big investments, and I'm planning to add more in February. Tyler, what are you looking at?
So I've been looking a lot at oil and gas companies lately, particularly outside of independent oil and gas producers. I don't necessarily want to be that connected to oil and gas prices, but there is a lot of value, I think, in what's going on in the oil and gas industry in general. A lot of undervalued assets for what they're doing. And one company that I've recently purchased for a managed account that I do for somebody else is HF Sinclair Corporation. This is an oil refining company and also a retail marketing. It's a combination of a publicly traded refinery called Holly Frontier. It merged with a private company called Sinclair. If you've ever, mostly on the West Coast or kind of the Rocky Mountain region, if you've ever seen Sinclair gas stations, they're the ones with the big dinosaur. So just to give you some familiarity who they are. One of the things that I followed this company for a long time, and one thing I've always respected about this company is they've been spectacularly good at just kind of managing their business in terms of not just, efficient operations, but also allocation of capital. Um, for the past 10 years, outside of 2020 when oil prices went negative and oil demand was really, really down because nobody was moving, we were all in pandemic lockdowns, what have you. Outside of that 1 year, over the past 10 years, HF Sinclair has more or less averaged better than 10% return on equity, which for a refiner is spectacular news. This isn't an industry that grows revenue. Like you don't hear a lot of new refineries being built. You don't see a lot of kind of rapid capital expansion. Mostly it's a lot of maintenance capital to keep the existing facilities running, maybe upgrade them a little bit to, maybe make more diesel and gasoline versus kind of other products that are less desirable or not as expensive, and little tweaks around the corner. You're starting to see some that are, tagging on things like renewable diesel facilities built into the refineries because it's a relatively easy transition. But all in all, like I said, not a lot of capital to go into the business to keep it running, which is great because then HF Sinclair gets to return boatloads of this capital back to its shareholders. As of right now, it has a 3.2% dividend yield, which isn't fantastic. But one of the things that really stood out is over the past year, they repurchased about 10% worth of their shares, just in share buybacks alone, giving you an idea of like how much, no, not only how much they're willing to reward shareholders, but also at the same time how relatively cheap the stock is. It's hard to buy back 10% of a company in any given year. And part of the reason they can do that is because they're trading for so cheap. As of right now, the company's trading for about 4.8 times earnings and 3.8 times free cash flow. This is giving you an idea of how cheap it is. Now, because it is refining, it's not a high growth industry. Anyone who invests in a business like this should go in knowing you're never going to get a higher multiple. Like you're not going to buy this thing and all of a sudden it's going to go to market average like 20 times earnings or anything like that. No, it's going to be cheap almost all the time. Maybe you might get 10, 11, 12 times earnings, maybe once or twice, and that may actually be because of declining earnings during the ups and downs of the cycle. But don't go into this thinking that you're going to get a huge uptick in price because of a higher valuation. Instead, you're buying this company for its earnings power and its ability to reward shareholders with buybacks and dividends, which I understand it's not the best sales pitch for anybody looking to buy something that's going to grow this year. But if it's something you want to put capital to work for 10 or more years, that's a pretty attractive proposition.